Welcome. If you're just starting your investment journey, understanding asset allocation is one of the most important steps you can take. Asset allocation simply means deciding how to divide your money among different types of investments, like stocks, bonds, and cash. This approach helps manage risk and can improve your chances of reaching your financial goals. In this video, we'll break down what a realistic asset allocation plan looks like for beginners, why it matters, and how you can get started with confidence. Let's begin by exploring the basics of asset allocation and why it's the foundation of a smart investment strategy. Asset allocation is crucial because it helps you balance risk and reward based on your personal goals and comfort with risk. By spreading your investments across different asset classes, you reduce the impact of any single investment's poor performance on your overall portfolio. This means if one area of the market is struggling, your other investments can help cushion the blow. For beginners, this approach is especially important because it creates a safety net while you learn more about investing. Next, let's look at the main types of assets you can include in your allocation plan. There are three main asset classes you'll encounter: stocks, bonds, and cash. Stocks represent ownership in companies and offer the potential for high returns, but they come with higher risk. Bonds are loans to governments or companies and tend to be less risky, providing steady income. Cash includes savings accounts and money market funds, offering safety and liquidity but low returns. Each asset class behaves differently, so combining them can help you achieve a smoother investment experience. Now, let's see how you might divide your money among these options as a beginner. Most beginners, a common starting point is the 60-30-10 rule: 60% in stocks, 30% in bonds, and 10% in cash. This mix gives you growth potential from stocks, stability from bonds, and flexibility from cash. Of course, this is just a guideline. Your ideal allocation depends on your age, goals, and risk tolerance. If you're younger and have a long time before you need the money, you might lean more towards stocks. If you're closer to needing your funds, you might prefer more bonds and cash. Let's break down why this mix works well for many new investors. Stocks are often called the growth engine of your portfolio. Over the long term, they have historically provided the highest returns compared to other asset classes. However, stocks can also be volatile, meaning their value can go up and down quickly. For beginners, having a significant portion in stocks helps your money grow, especially if you have many years before you need to access your investments. But it's important not to put all your eggs in one basket. That's why we balance stocks with other assets. Next, let's talk about bonds and their role in your plan. Bonds add stability and income to your portfolio. They tend to be less risky than stocks and provide regular interest payments. When the stock market is turbulent, bonds can help smooth out your returns and reduce overall risk. For beginners, including bonds in your allocation means you're not relying solely on the ups and downs of the stock market. This balance can help you stay invested during tough times and avoid making emotional decisions. Now let's see why keeping some cash on hand is also important. Cash is the most stable part of your portfolio. It doesn't grow much, but it's there when you need it. Having some cash means you can cover emergencies or take advantage of new investment opportunities without having to sell your stocks or bonds at a bad time. For beginners, keeping about 10% of your portfolio in cash is a good rule of thumb. This gives you peace of mind and flexibility as you learn more about investing. Next, let's talk about how your age and goals can affect your asset allocation choices. Your age plays a big role in how you should allocate your assets. The younger you are, the more time you have to recover from market ups and downs, so you can afford to take more risk with stocks. As you get older and approach your financial goals, it's wise to shift gradually toward more bonds and cash to protect what you've built. A common rule is to subtract your age from 100 to find the percentage of your portfolio that could be in stocks. For example, if you're 30, you might have 70% in stocks. Let's see how your goals also shape your plan. Before you decide on your asset allocation, think about your financial goals. Are you saving for retirement, a home, or something else? The time frame for your goals will influence how much risk you can take. If your goal is far away, you can invest more aggressively. If it's coming up soon, you'll want to be more conservative. Being clear about your goals helps you choose the right mix of assets and stay focused even when the market gets bumpy. Next, let's discuss how to assess your personal risk tolerance. Risk tolerance is all about how comfortable you are with the ups and downs of investing. Some people can handle big swings in their portfolio's value while others prefer a smoother ride. To figure out your risk tolerance, think about how you'd feel if your investments dropped in value. Would you stay calm or panic and sell? Your answer will help you decide how much to put in stocks versus bonds and cash. Remember, there's no right or wrong answer, just what works for you. Now, let's look at how to put your plan into action. Once you've thought about your goals, age, and risk tolerance, it's time to start investing. You don't need a lot of money to begin. Many platforms let you start with just a small amount. Focus on building your portfolio gradually, adding more as you're able. The key is to get started and stay consistent. Over time, your investments can grow and compound, helping you reach your goals. In the next scene, we'll talk about choosing the right investment account. There are different types of accounts you can use to invest, such as retirement accounts, like IRAs or 401(k)s, and regular brokerage accounts. Retirement accounts often offer tax advantages, which can help your money grow faster. Brokerage accounts are more flexible and let you access your money at any time. For beginners, it's a good idea to start with a retirement account if you're saving for the long term, and use a brokerage account for shorter term goals. Next, let's discuss the importance of diversification. Diversification means spreading your investments across different assets, industries, and even countries. This reduces the risk that any one investment will hurt your overall portfolio. For example, if you only invest in tech stocks and that sector struggles, your portfolio could take a big hit. But if you also own bonds, cash, and stocks from other industries, you're better protected. Diversification is a key principle for beginners and experienced investors alike. Let's see how you can diversify within each asset class. Within your stock allocation, you can diversify by investing in companies of different sizes, industries, and regions. For example, you might own shares in large companies, small startups, and international firms. This way, if one area struggles, others might do well. Many beginners use index funds or exchange-traded funds (ETFs) to easily achieve that kind of diversification. These funds hold a wide range of stocks, making it simple to spread your risk. Next, let's look at how to diversify your bond investments. Just like with stocks, you can diversify your bond holding by choosing bonds from different issuers, such as governments and corporations, and with different maturity dates. Some bonds are short-term while others are long-term. Mixing these helps protect your portfolio from interest rate changes and other risks. Bond funds and ETFs can also make diversification easier for beginners. Now, let's talk about the role of cash and how to manage it effectively. Managing your cash means keeping enough on hand for emergencies and short-term needs, but not so much that your money isn't working for you. Consider keeping your cash in a high-yield savings account or a money market fund, where it can earn a bit of interest while staying safe and accessible. Review your cash needs regularly and adjust as your situation changes. Next, let's discuss how often you should review and rebalance your asset allocation. It's important to review your asset allocation at least once a year, or whenever you experience a major life change like a new job or a big purchase. Over time, your investments may grow at different rates, causing your allocation to drift away from your original plan. Regular reviews help you stay on track and make adjustments as needed. In the next scene, we'll explain how to rebalance your portfolio. Balancing means bringing your portfolio back to your target allocation. For example, if stocks have done really well and now make up more than 60% of your portfolio, you might sell some stocks and buy more bonds or cash to restore your original mix. This process helps you manage risk and stick to your plan even when markets are unpredictable. Most beginners rebalance once a year, but you can do it more or less often depending on your needs. Next, let's talk about keeping costs low. Investment costs like fund fees and trading commissions can eat into your returns over time. For beginners, it's smart to choose low-cost index funds or ETFs, which often have lower fees than actively managed funds. Many online brokers now offer commission-free trading, making it easier to keep costs down. Always check the expense ratios of any funds you consider. Keeping costs low means more of your money stays invested and working for you. Next, let's discuss the importance of patience and discipline. Investing is a long-term journey, and it's normal for markets to go up and down. The most successful investors are those who stick to their plan, avoid emotional decisions, and give their investments time to grow. Don't try to time the market or chase the latest trends. Instead, focus on your goals and trust your asset allocation strategy. Over time, patience and discipline can make a big difference in your results. Now, let's talk about common mistakes beginners should avoid. Some common mistakes beginners make include putting all their money in one investment, ignoring fees, and making changes based on emotions. It's also easy to forget about rebalancing or take on too much risk. By following a realistic asset allocation plan and reviewing it regularly, you can avoid these pitfalls. Remember, investing is about building wealth over time, not getting rich quick. Next, let's look at how you can keep learning as you invest. The world of investing is always changing, and there's always more to learn. Read books, follow reputable financial websites, and consider taking online courses to deepen your understanding. The more you learn, the more confident you'll feel about your asset allocation choices. Don't be afraid to ask questions or seek advice from trusted sources. Next, let's talk about the benefits of starting early. One of the biggest advantages you have as a beginner is time. The earlier you start investing, the more you benefit from compounding, where your returns start earning returns of their own. Even small amounts can grow significantly over decades. Don't wait for the perfect moment. Start with what you have and build from there. In the next scene, we'll discuss how to stay motivated on your investment journey. Investing can sometimes feel slow, especially in the beginning. To stay motivated, set clear goals and celebrate your progress along the way. Track your investments and watch how they grow over time. Remember, every step you take brings you closer to your financial goals. Surround yourself with positive influences and keep your focus on the long term. Next, let's look at how to handle market downturns. Market downturns are a normal part of investing. When markets fall, it's natural to feel worried, but remember that downturns are usually temporary. Sticking to your asset allocation plan can help you ride out the storm and avoid making decisions you might regret later. If you've diversified and balanced your portfolio, you're already prepared for tough times. Next, let's talk about when you might need to adjust your plan. You don't need to change your asset allocation often, but there are times when it makes sense. Major life events like getting married, having a child, or changing jobs can affect your goals and risk tolerance. Review your plan when these events happen and make adjustments if needed. Otherwise, stick to your strategy and avoid making changes based on short-term market movements. Next, let's discuss the importance of having an emergency fund. Before you invest too much, make sure you have an emergency fund, money set aside for unexpected expenses like car repairs or medical bills. Aim for 3 to 6 months worth of living expenses in a safe, accessible account. This fund acts as a financial cushion and keeps you from having to sell investments at a bad time. Once your emergency fund is in place, you can invest with more confidence. Next, let's talk about automating your investment. Automating your investments means setting up regular automatic contributions to your accounts. This makes investing a habit and helps you stay consistent, even when life gets busy. Many platforms let you set up automatic transfers from your bank account. Automation also helps you take advantage of dollar cost averaging, where you buy investments at different prices over time, reducing the impact of market swings. Next, let's discuss the value of seeking professional advice. If you're unsure about your asset allocation or need help getting started, consider talking to a financial advisor. Advisors can help you clarify your goals, assess your risk tolerance, and create a personalized plan. Look for advisors who are fee-only and act in your best interest. Even if you prefer to manage your own investments, getting professional advice can give you peace of mind and help you avoid costly mistakes. Next, let's talk about using online tools and resources. There are many online tools and calculators that can help you plan your asset allocation. These tools let you input your age, goals, and risk tolerance to suggest a mix of stocks, bonds, and cash. Some platforms even offer robo-advisors, which automatically manage your portfolio based on your preferences. Using these resources can make investing easier and more accessible for beginners. Next, let's discuss the importance of staying informed about your investment. Keeping up with your investments doesn't mean checking them every day, but it's important to stay informed about major changes in the market and your portfolio. Set aside time every few months to review your accounts, read financial news, and make sure your plan still fits your goals. Staying informed helps you make better decisions and avoid surprises. Next, let's talk about the role of emotions in investing. Emotions can have a big impact on investing. Fear and greed can lead to poor decisions like selling during a downturn or buying into a hot trend. Recognize your emotions and try to separate them from your investment choices. Having a clear asset allocation plan helps you stay focused and avoid reacting to short-term market movements. Next, let's discuss the benefits of long-term thinking. Long-term thinking is one of the most powerful tools for investors. Markets will always have ups and downs, but over time they tend to grow. By focusing on your long-term goals and sticking to your asset allocation, you give your investments the best chance to succeed. Don't let short-term noise distract you from your bigger picture. Next, let's look at how to track your progress. Tracking your progress helps you stay motivated and make sure you're on the right path. Use spreadsheets, apps, or your investment platform's tools to monitor your portfolio's performance. Compare your results to your goals and make adjustments if needed. Remember, progress may be slow at first, but consistency pays off. Next, let's talk about celebrating your investment milestones. Every time you reach a savings goal or stick to your investment plan for another year, take a moment to celebrate. Recognizing your achievements keeps you motivated and reinforces good habits. Investing is a marathon, not a sprint, so enjoy the journey and be proud of your progress. Next, let's discuss the importance of staying flexible as your life changes. Life is full of surprises and your financial situation may change over time. Stay flexible and be willing to adjust your asset allocation as your goals, income, or risk tolerance evolve. Flexibility helps you stay on track and make the most of new opportunities. Next, let's talk about the role of taxes in investing. Taxes can affect your investment returns, so it's important to understand how they work. Different accounts and investments are taxed in different ways. For example, retirement accounts often let your money grow tax-free or tax-deferred, while brokerage accounts may be subject to capital gains taxes. Being aware of taxes helps you make smarter decisions and keep more of your returns. Next, let's discuss the benefits of low-maintenance investing. Low-maintenance investing means setting up your asset allocation and letting it work for you with minimal effort. Index funds, ETFs, and automated platforms make it easy to stay diversified and on track. This approach is perfect for beginners who want to invest without spending a lot of time managing their portfolio. Next, let's talk about the importance of reviewing your plan regularly. Even with a low-maintenance approach, it's important to review your plan regularly. Check in at least once a year to make sure your allocation still fits your goals and risk tolerance. Life changes and your plan should change with it. Regular reviews help you stay proactive and avoid surprises. Next, let's discuss the value of community and support. Investing can feel overwhelming at times, but you're not alone. Joining a community of like-minded investors can provide support, encouragement, and valuable insights. Look for online forums, local groups, or social media communities focused on personal finance and investing. Sharing experiences and learning from others can help you stay motivated and make better decisions. Next, let's talk about setting realistic expectations. It's important to have realistic expectations about investing. Markets won't always go up, and there will be periods of slow growth or even losses. Focus on your long-term goals and remember that steady progress is better than chasing quick wins. By setting realistic expectations, you'll be less likely to get discouraged and more likely to stick with your plan. Next, let's discuss the importance of celebrating your financial independence. Reaching financial independence is a major milestone. It means you have enough savings and investments to support your lifestyle without relying on a paycheck. Celebrate your progress and enjoy the freedom that comes with smart investing. Remember, financial independence doesn't happen overnight, but every step you take brings you closer. Next, let's wrap up with a summary of what we've learned. Let's recap the main points. Asset allocation is about dividing your investments among stocks, bonds, and cash to balance risk and reward. Start with a simple plan, adjust for your age, goals, and risk tolerance, and review your allocation regularly. Diversify within each asset class, keep costs low, and stay patient. Remember to automate your investments, seek support, and keep learning as you go. Now, let's look at some final tips for success. As a beginner, focus on building good habits. Start early, invest consistently, and don't let emotions drive your decisions. Use low-cost funds, automate your contributions, and review your plan regularly. Remember, investing is a journey, not a race. Stay curious, keep learning, and celebrate your progress along the way. With a realistic asset allocation plan, you're well on your way to financial success. Thank you for watching, and best of luck on your investment journey. Congratulations on taking the first step towards smart investing. Remember, the most important thing is to get started and keep moving forward. Review your asset allocation plan, make adjustments as needed, and stay committed to your goals. The journey to financial independence begins with a single step, and you're already on your way. Keep learning, stay patient, and enjoy the process. Wishing you success and confidence as you build your financial future.